Question 1. An investor seeking current income, capital appreciation, and professional management, while also prioritizing diversification across various securities, would most likely invest in A. Exchange-traded fund, ETF. B. Fixed annuity. C. Mutual fund. D. Certificate of deposit, CD. Answer: C. Mutual fund. A mutual fund is a professionally managed portfolio of stocks, bonds, or other securities that offers diversification and aims for specific investment objectives, making it ideal for investors seeking income, growth, and professional management. Investors buy shares in the fund, and their money is pooled with other investors' funds to buy a diverse portfolio of securities. Unlike individual stocks or bonds, mutual funds automatically provide diversification, reducing overall risk, and are overseen by fund managers. Remember that mutual funds are a common way for new investors to gain broad market exposure. Question 2. Which of the following statements is true regarding a common stock owner's voting rights? A. Common stockholders vote for the company's dividend payout ratio. B. Common stockholders have the right to vote for preferred stock issuance. C. Common stockholders vote for members of the board of directors. D. Common stockholders vote on major day-to-day operational decisions. Answer: C. Common stockholders vote for members of the board of directors. Common stockholders are the true owners of a corporation and have the right to vote on significant corporate matters, most notably for the board of directors. The board then oversees the management team, which makes day-to-day operational decisions. While dividends are important, the board of directors, not common shareholders directly, decides the dividend payout. Understanding that common stock carries voting rights for the board is a fundamental concept in corporate governance. Question 3. Under FINRA rules, a registered representative is required to complete the regulatory element of their continuing education. A. Annually. B. Every 3 years. C. Biannually. D. Only once after their initial registration. Answer: B. Every 3 years. The regulatory element is a mandatory component of continuing education for registered representatives, designed to ensure they stay current with industry rules and regulations. It must be completed within 120 days of the representative's second registration anniversary, and then every 3 years thereafter for as long as they remain registered. This ongoing education helps maintain high standards of ethical conduct and compliance across the securities industry. Always remember that professional knowledge and adherence to rules are critical in this field. Question 4. An investor who sells a security short expects the price of the security to A. Increase. B. Decrease. C. Remain stable. D. Fluctuate randomly. Answer: B. Decrease. Selling short is an advanced investment strategy where an investor borrows shares and immediately sells them, hoping to buy them back later at a lower price to return to the lender. The core expectation behind a short sale is that the security's market price will decline, allowing the investor to profit from the difference between the initial sale price and the lower repurchase price. This strategy is bearish, meaning the investor anticipates a downtrend. Think of it as selling high first, then buying low later. Question 5. All of the following are typically considered investment companies except A. A face amount certificate company. B. A unit investment trust, UIT. C. A mutual fund. D. A hedge fund. Answer: D. A hedge fund. Investment companies are regulated entities that pool money from investors to invest in a portfolio of securities, and the Investment Company Act of 1940 defines specific types, including face amount certificate companies, unit investment trusts, UITs, and mutual funds, officially called open-end management companies. Hedge funds, on the other hand, are typically structured as private investment partnerships, largely unregulated by the Investment Company Act of 1940, and are generally available only to sophisticated, high net worth investors. Knowing the specific types of investment companies under the Act is crucial for the SIE. Question 6. A prospectus for a new issue of securities is typically provided to an investor. A. After they have purchased the securities. B. At or before the confirmation of sale. C. Only upon request. D. Within 30 days of the offering date. Answer: B. At or before the confirmation of sale. A prospectus is a legal document that provides detailed information about a new security offering, including risks, financial statements, and the company's business. Securities regulations require that a final prospectus be delivered to a prospective purchaser at or before the confirmation of the sale of the new issue to ensure the investor has sufficient information to make an informed decision. This requirement is a cornerstone of investor protection in the primary market. Always ensure investors receive this vital information before finalizing their purchase. Question 7. Which of the following types of risk would most directly impact an investor holding a diversified portfolio of fixed-income securities during a period of rising interest rates? A. Liquidity risk. B. Business risk. C. Interest rate risk. D. Reinvestment risk. Answer: C. Interest rate risk. Interest rate risk is the risk that the value of a bond or other fixed-income investment will decline due to a rise in interest rates. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive and thus decreasing their market value. This risk is particularly significant for long-term bonds and can affect even a diversified portfolio of fixed-income securities. Remember that bond prices move inversely to interest rates. Question 8. A registered representative receives an order from a customer who is a minor. Which of the following is the most appropriate action for the representative to take? A. Execute the order, as the minor is technically a customer. B. Open a new joint account for the minor and a parent. C. Inform the minor that the account cannot be opened in their name and that the order cannot be accepted directly. D. Seek approval from the firm's legal department before executing the order. Answer: C. Inform the minor that the account cannot be opened in their name and that the order cannot be accepted directly. Minors, by law, are not considered to have the legal capacity to enter into contracts, including opening brokerage accounts. Therefore, a registered representative cannot open an account directly in a minor's name or accept orders from them. For a minor to own securities, a custodial account, like an UGMA or UTMA, must be established, with an adult acting as custodian. This protects both the minor and the firm from potential legal issues arising from contractual incapacity. Question 9. An investment that combines the features of a bond and common stock, offering fixed dividends but typically no voting rights, is known as A. A treasury bill. B. A preferred stock. C. A convertible bond. D. A warrant. Answer: B. A preferred stock. Preferred stock is a type of equity security that pays a fixed dividend, similar to bond interest payments, but typically does not carry voting rights like common stock. It gets its preferred status because its dividend payments take precedence over common stock dividends, and preferred stockholders have a higher claim on company assets than common stockholders in the event of liquidation. Think of preferred stock as a hybrid security with characteristics of both debt and equity. Question 10. The department of a broker-dealer that handles the buying and selling of securities for its own account, rather than for clients, is known as the A. Retail Department. B. Underwriting Department. C. Trading Desk or Proprietary Trading. D. Operations Department. Answer: C. Trading Desk or Proprietary Trading. The Trading Desk or Proprietary Trading Department at a broker-dealer engages in buying and selling securities for the firm's own capital and profit, rather than executing trades on behalf of customers. This contrasts with the Retail Department, which serves individual investors, or the underwriting department, which helps companies issue new securities. Understanding the distinct roles of different departments within a broker-dealer is important for recognizing potential conflicts of interest. Question 11. Which of the following defines the primary market? A. Where securities are traded between investors after their initial issuance. B. Where new issues of securities are sold to the public for the first time. C. Where options contracts are traded. D. Where foreign currencies are exchanged. Answer: B. Where new issues of securities are sold to the public for the first time. The primary market is the segment of the capital markets where new securities are created and sold for the first time to investors, typically through an initial public offering, IPO, or a subsequent primary offering. This is where the issuing company directly raises capital by selling its stocks or bonds. In contrast, the secondary market is where investors trade existing securities among themselves. Remember, primary means first issuance. Question 12. A broker-dealer must establish and maintain an anti-money laundering (AML) program that is designed to detect and report suspicious activities. This program is mandated by A. The Securities and Exchange Commission, SEC. B. The Financial Crimes Enforcement Network, FINCEN. C. The Municipal Securities Rulemaking Board, MSRB. D. The Federal Reserve Board. Answer: B. The Financial Crimes Enforcement Network, FINCEN. Broker-dealers are required by the Bank Secrecy Act, as administered by the Financial Crimes Enforcement Network, FINCEN, to establish and maintain an anti-money laundering (AML) program. This program is crucial for identifying and reporting suspicious transactions, such as large cash deposits or unusual activity, to prevent financial crimes. FINCEN sets the rules for reporting suspicious activity, including Suspicious Activity Reports, SARs. Always recall that FINCEN is the key agency for AML compliance. Question 13. Which of the following statements about an investment advisor representative, IAR, is true? A. An IAR primarily executes trades for customers based on unsolicited orders. B. An IAR provides advice about securities for compensation. C. An IAR sells only mutual funds and variable annuities. D. An IAR's compensation is solely based on commissions from executed trades. Answer: B. An IAR provides advice about securities for compensation. An investment advisor representative, IAR, is a person who, for compensation, provides advice about securities, manages client accounts, or solicits advisory services on behalf of an investment advisor. Unlike a registered representative, broker, whose primary role is to execute transactions, an IAR's main function revolves around providing investment advice. Their compensation can be fee-based rather than solely commission-based. Understanding the distinction between advice and transaction execution is key. Question 14. All of the following are types of investment risk except A. Legislative risk. B. Credit risk. C. Diversification risk. D. Inflation risk. Answer: C. Diversification risk. Diversification is a strategy used to reduce unsystematic risk by investing in a variety of assets, not a type of risk itself. Common types of investment risk include legislative risk, changes in laws affecting investments, credit risk, the risk that a borrower will default on debt, and inflation risk, the risk that rising prices will erode purchasing power. Therefore, diversification is a risk management technique, not an inherent risk category. Remember that diversification is your friend, not your foe, when it comes to risk. Question 15. A customer opens a cash account and wants to purchase 100 shares of XYZ stock. Under which rule is the customer required to pay for the securities? A. Regulation T. B. Regulation U. C. Rule 144. D. The Uniform Securities Act. Answer: A. Regulation T. Regulation T, promulgated by the Federal Reserve Board, governs the extension of credit by broker-dealers to customers for the purchase of securities. For cash accounts, it specifies that payment for securities purchased must be received promptly, typically within 2 business days after the settlement date, T+2, meaning 4 business days from the trade date, T+4. This rule is crucial for ensuring timely settlement of transactions in the securities industry. Question 16. What is the main purpose of the Securities Investor Protection Corporation, SIPC? A. To regulate broker-dealers and exchanges. B. To protect customers against losses due to broker-dealer failure. C. To provide advice on suitable investments. D. To ensure bank deposits. Answer: B. To protect customers against losses due to broker-dealer failure. The Securities Investor Protection Corporation, SIPC, is a non-profit corporation that protects customers of brokerage firms from financial loss if a SIPC member firm fails. It covers customer cash and securities up to $500,000, including a $250,000 limit for cash. SIPC does not protect against market losses or poor investment performance. Its sole focus is on protecting against the insolvency of a brokerage firm. Think of SIPC as similar to FDIC for banks, but for brokerage accounts. Question 17. An investor owns an S&P 500 exchange-traded fund, ETF. This investor benefits from A. Fixed, predictable income payments. B. Direct ownership of the underlying stocks in the S&P 500. C. Diversification and intraday trading flexibility. D. Management by a professional actively trying to outperform the S&P 500. Answer: C. Diversification and intraday trading flexibility. An S&P 500 exchange-traded fund, ETF, is a security that tracks an index like the S&P 500 but trades like a common stock on an exchange. This offers investors immediate diversification by holding a basket of securities, similar to a mutual fund, but with the added benefit of being able to be bought and sold throughout the trading day at market prices, unlike mutual funds that are priced only once per day at net asset value, NAV. ETFs typically track an index, rather than being actively managed to outperform it. Question 18. Which of the following is an example of a capital market instrument? A. A 90-day Treasury bill. B. A municipal bond maturing in 20 years. C. Commercial paper. D. A repurchase agreement. Answer: B. A municipal bond maturing in 20 years. Capital market instruments are long-term debt or equity instruments with maturities typically greater than 1 year, used to raise capital for long-term investments. Examples include stocks, bonds, and notes with long maturities. A municipal bond maturing in 20 years clearly falls into this category. In contrast, Treasury bills, commercial paper, and repurchase agreements are money market instruments, characterized by short-term maturities, 1 year or less, and high liquidity. Question 19. A registered representative is opening a new account for a customer and must obtain certain information. Which of the following pieces of information is not mandatory to open the account, though highly recommended for suitability purposes? A. Customer's name and address. B. Customer's social security number. C. Customer's investment objectives. D. Customer's employment status. Answer: C. Customer's investment objectives. To open a new account, a broker-dealer is legally required to obtain specific information for identification and regulatory compliance, such as the customer's name, address, date of birth, and social security number. While the customer's investment objectives, financial status, and risk tolerance are crucial for determining suitability and making appropriate recommendations, they are not strictly mandatory to open a basic cash account, but are essential for executing transactions and fulfilling suitability obligations. Always remember that identifying information is mandatory for account opening, while suitability information is vital for recommending investments. Question 20. Which of the following would be considered a restricted person and generally prohibited from purchasing shares in an initial public offering, IPO? A. An individual with an income exceeding $200,000 per year. B. An employee of the company whose shares are being offered. C. A registered representative of the underwriting broker-dealer. D. A close family member of the CEO of the issuing company. Answer: C. A registered representative of the underwriting broker-dealer. FINRA Rule 5130, known as the New Issue Rule, generally prohibits restricted persons from purchasing shares in an initial public offering, IPO, to ensure that public offerings are genuinely available to the public and to prevent industry insiders from profiting unfairly. A registered representative of the underwriting broker-dealer is explicitly defined as a restricted person under this rule. This rule aims to promote fairness and public trust in the IPO process. Question 21. What is the primary characteristic of a market order? A. It is executed at a specific price or better. B. It is executed immediately at the best available price. C. It remains active until cancelled or executed at a specified price. D. It is executed only if the price moves against the investor. Answer: B. It is executed immediately at the best available price. A market order is the most basic type of order and instructs a broker to buy or sell a security immediately at the best price currently available in the market. It prioritizes execution speed over price certainty, meaning it will be filled without delay, though the exact price might vary slightly from what was initially seen. This type of order is commonly used when an investor wants to ensure their trade gets done as quickly as possible. Understand that a market order's primary goal is immediate execution. Question 22. A customer wants to transfer their account from one broker-dealer to another. What is the standard time frame for the carrying firm to complete the transfer request under industry rules? A. 1 business day. B. 3 business days. C. 10 business days. D. 30 calendar days. Answer: B. 3 business days. Under FINRA Rule 11870, Customer Account Transfer Contracts, when a customer requests a transfer of their account, the carrying member, the firm from which the account is being transferred, generally has 1 business day to validate the transfer request and 3 business days to complete the transfer of assets after validation. This ensures an efficient and timely process for customers moving their investments between firms. Knowing these specific deadlines is important for operational compliance. Question 23. An investor purchases a call option. This investor expects the price of the underlying security to A. Remain stable. B. Decrease. C. Increase. D. Volatilize significantly. Answer: C. Increase. A call option gives the holder the right, but not the obligation, to buy a specified amount of an underlying asset at a predetermined price, the strike price, on or before a certain expiration date. An investor buys a call option when they are bullish on the underlying asset, meaning they expect its price to increase significantly above the strike price, allowing them to profit from exercising the option or selling it for a higher premium. Remember, call up, you want the price to go up. Question 24. The maximum loss for an investor who buys a call option is A. Unlimited. B. The strike price. C. The premium paid. D. The difference between the strike price and the market price. Answer: C. The premium paid. When an investor buys a call option, the most they can lose is the initial amount they paid for the option, which is known as the premium. If the underlying asset's price does not rise above the strike price before expiration, the option will expire worthless, and the investor will lose only the premium paid. This fixed maximum loss is a key characteristic that makes buying options different from direct stock ownership. Question 25. An investor's portfolio is heavily concentrated in domestic small-cap stocks. Which of the following risks would this portfolio be most susceptible to? A. Exchange rate risk. B. Political risk. C. Liquidity risk. D. Call risk. Answer: C. Liquidity risk. Liquidity risk is the risk that an investment cannot be bought or sold quickly enough at a fair market price, often because there isn't an active market for it. Small-cap stocks, especially those not widely traded, are typically less liquid than large-cap stocks or established bonds. If an investor needed to sell a large position quickly, they might have to accept a significantly lower price due to a lack of buyers. Contrast this with exchange rate risk, foreign investments, or political risk, government actions, which are less direct concerns for domestic small-cap stocks.